Ever wondered why some thrive while others barely survive during a market crash? Many investors panic sell, hoard cash, or worse, do nothing at all, leaving their financial future at the mercy of market turbulence. In this video, I'll reveal 10 essential money rules to not only survive but thrive during a market crash. From strategic investing insights to psychological resilience tips, you'll gain actionable strategies to safeguard your wealth and even capitalize on opportunities. By the end of this video, you'll be equipped with a solid plan to navigate market crashes with confidence, ensuring your financial goals remain on track despite the storm. Subscribe the Wealthy channel and let's dive in. Number 1. Don't believe the hype. In every market crash, there's a flood of fear-driven headlines. The economy is collapsing. Sell before it's too late. This time is different. But here's the truth. The people who listen to this noise always lose. History shows that those who panic and sell in downturns often lock in losses, while the wealthy quietly buy assets at bargain prices. When the market is bleeding red, most people react emotionally instead of strategically. And what happens? They sell low, regret it later, and watch from the sidelines as the market rebounds, just like it always does. Instead of consuming fear-based news, consume facts. Instead of reacting emotionally, set a game plan. Stick to proven strategies, dollar-cost averaging, buying undervalued assets, and staying invested long-term. Stop chasing noise. Start chasing wealth. Fear makes you broke. Facts make you rich. Number 2. Spread your risk like the rich. Imagine boarding a plane and the pilot announces, "We have only one engine, but don't worry, it's strong." You'd panic, right? That's exactly how people invest, putting all their money into one stock, one business, or one asset class. And when a market crash hits, boom, their entire portfolio crashes with it. The biggest mistake people make is betting everything on a single asset, whether it's stocks, crypto, or real estate, believing it will keep going up forever. Now let's talk solutions. Instead of gambling on one asset, follow the rule of the wealthy. Spread your risk. Invest across stocks, bonds, gold, real estate, and even businesses. This way, when one market crashes, others balance it out. If one investment crashes, your entire future shouldn't. Spread your money wisely. Number 3. See the big picture. Most people treat the stock market like a slot machine, expecting instant jackpots and panicking when they don't hit big overnight. Wealth isn't built in months, it's built over decades. The single most powerful factor in wealth building isn't intelligence, it's time. Every single time the market recovered and hit new highs. But only those who stayed invested reap the rewards. Patience turns downturns into opportunities. If you invest today, think in 10, 20-year horizons, not 10, 20 weeks. Here's what you do. Stop checking your portfolio daily, reinvest your dividends, and let compound interest do its magic. Long-term investors don't fear market crashes. They see them as discount sales. Play the long game and you'll always win. Short-term fear leads to long-term regret. Zoom out and stay invested. The market rewards patience, not panic. Every crash in history has been temporary. Number 4. Balance risk and reward. A market crash is like a storm. You don't want to be caught in a flimsy boat with no life jacket. Yet, so many investors take extreme risks, chasing sky-high returns without considering the downside. Then, when the market collapses, they lose everything and panic sell at the worst time. In The Intelligent Investor, Benjamin Graham warns, the investor's chief problem and even his worst enemy is likely to be himself. People either go all in on risky bets or play it too safe and miss out on growth. Both are mistakes. If you take too much risk, you might lose sleep, wealth, and peace of mind. If you avoid risk completely, inflation will eat your savings alive. The key? Balance. Take the 60-40 rule. 60% in stocks for growth, 40% in bonds for stability. Even in the worst crashes, this mix has outperformed panic-driven strategies. Divide your money, some in high-growth assets, some in safe havens like bonds or gold. This way, you get the upside without losing your sanity. Number 5. Set stop-loss disciplines. Set stop-loss disciplines. Protect your investments with predefined exit points to limit losses during market declines. Ask yourself, at what point would I sell to preserve capital? Implementing stop-loss orders can safeguard your portfolio from significant downturns. Discipline trumps emotion in investing. Setting and sticking to stop losses can prevent emotional decision-making and preserve your capital for future opportunities. Number 6. Maintain liquidity. Most people have zero liquidity when disaster strikes. They've tied up all their money in stocks, real estate, or speculative assets, leaving them broke when they actually need cash. Warren Buffett famously said, "Cash combined with courage in a crisis is priceless." The best investments happen when everyone else is panicking and you're the one with cash ready to buy. Want to avoid being stuck in a cash crisis? Keep 12 months worth of living expenses in an accessible account. Also, have a line of credit or liquid investments that can be converted into cash without losing value. Because in every crash, there are two types of people: those forced to sell everything and those ready to buy everything. Be the second type. Number 7. Invest in quality assets. When a market crash hits, weak companies collapse, and only the strongest survive. The biggest mistake? People chase hype stocks, trendy investments, or cheap opportunities without checking their real value. Invest in quality assets. During market turmoil, focus on fundamentally strong companies with solid earnings and robust business models. Ask yourself, which companies will likely weather the storm? Quality assets may experience temporary setbacks but are poised for long-term growth. Quality over quantity pays off. Investing in reliable assets can deliver sustainable returns and shield your portfolio from volatility. Weak companies don't survive crashes. Invest in proven winners. Never buy a stock just because it's cheap. Buy because it's valuable. Number 8. Be prepared for opportunities. When a market crash happens, most people panic. They freeze, sell in fear, and miss the biggest wealth-building opportunity of their lives. The truth: market crashes don't destroy wealth. They transfer it, from the impatient to the patient, from the unprepared to the prepared. If you want to make life-changing wealth, stop reacting, start preparing. Research companies now. Save cash. Set alerts. When the next crash hits, you won't be panicking like the rest. You'll be buying assets at bargain prices while everyone else is running scared. Opportunities don't wait. Only the prepared can seize them. A market crash is a wealth transfer event. Be on the receiving side. Number 9. Continue to learn and adapt. Continue to learn and adapt. The financial markets evolve, and so should your investment strategy. Ask yourself, am I staying informed about market trends and economic developments? Continuous learning enhances your ability to make informed decisions. Knowledge is power in investing. Stay curious, stay informed, and be willing to adjust your strategy based on new information and changing market conditions. In conclusion, navigating a market crash requires knowledge, discipline, and foresight. By following these rules, you can protect your investments, capitalize on opportunities, and emerge stronger financially. Remember to like, subscribe, and hit the notification bell for more insightful content on wealth building and financial freedom. Until next time, stay informed, stay empowered, and stay ahead. Happy investing!